Hi, I'm here today with Jim Jackson, Portfolio Manager for Core Bond and Core Plus Fixed Income Strategies. So Jim, I'm curious, given the wildly different levels of success of active bond managers in the marketplace, what differentiates your and your team's investment philosophy and investment process as it relates to active management of fixed income portfolios?
Thanks, Kelly. Our fixed income philosophy focuses on bottom-up credit selection and generating improved incremental income versus our peers and benchmarks. Our analysis shows that under a duration targeting framework, income drives returns over time. Our core competency is evaluating, taking, and managing credit risk. So our mandates target a duration that is consistent with industry benchmarks and attempts to drive alpha through credit selection. We consistently apply this process throughout the market cycle, and we do not position the portfolios on any interest rate predictions. Doing so, whether you predict rates are going to go up or down, tends to drive overall portfolio returns and outweigh any income generation. So on a year-to-year basis, your performance outcome is binary. Either you got the rate call right or you did not. We view our expertise across credit markets as an important advantage, as we can allocate across munis, corporates, or structured product to give the best benefit to our shareholders.
Thank you for that, Jim. And since you and your team focus on rigorous independent credit research, I'm curious how that's performed in this most recent rising interest rate environment, and more generally, how it's performed over the long term.
Yes, Kelly, the first quarter has certainly been an interesting time for fixed income investors. We've seen a pretty substantial increase in treasury rates and steepening of the treasury curve. This was driven in part by rising inflation expectations, increased GDP growth expectations, higher corporate earnings, greater fiscal spending. So there's a lot of things that pushed rates higher. But what we've seen in the first quarter is as rates moved up, investment grade credit spreads tightened 5 basis points during the quarter, and high yield credit spreads tightened 50 basis points during the quarter. So credit has provided a small ballast to the increase in rates. This is entirely what we would have expected based on our view of what's happened in the past. So credit spreads over the last 15 years were persistently negatively correlated to treasury rates. So this means that in a rising rate environments, credit spreads have the potential to act as a buffer to price declines driven by an increase in treasury rates.